Hi everyone, and welcome back to another video. Today we are going to be discussing stats. In particular, we're going to be looking at the two types of trading system that are available based on win rate and risk to reward. So you can either have a high win rate system and a low risk, relatively low risk to reward, or flip it and have a low win rate system with a much bigger risk to reward or reward to risk ratio. We're going to look at the two of them, the pros and cons, and why I believe it's difficult to stick to the better of the two, which is the lower win rate strategy with the higher risk to reward. But first we have to agree on something. So this little text here, if you look here, we have these bullet points, and I took this from Don Miller, who I will link to in the description box below. He is an S&P trader, ES futures contract trader, and he made, for those of you who don't know, he made $1.8 million on a pretty big account, but all the same he made $1.8 million over the course of about 16-18 months in 2008 to and a bit of 2009. So if you're interested, you can click that link below if you're interested in learning more about Don Miller. And this really resonated with me, which is the way markets move. It's quite simple. Breakouts lead to trends, trends lead to extremes, extremes lead to backing and filling, backing and filling leads to consolidations, and then consolidations lead to breakouts, and you wash, rinse, and repeat. So let's have a look at that visually to see what that means in a chart. So I'll read these out again as we move through the various phases while I show you on a chart. So let me get the pen up. Let's get the pen. We'll do a highlighter. Okay, so for example, just looking at, this is Friday's action on the yen. This is obviously a consolidation, and consolidations lead to breakouts. So this is news, it whipped down, and then this is a breakout, okay, of this consolidation. Breakouts lead to trends. So you have a trend, higher highs, higher lows, right? Makes a higher high, higher low, then it makes a higher high. Trends lead to extremes. Extremes lead to backing and filling. So you know, they take out the stop, they go back up, they take out the stop. Backing and filling leads to a consolidation, and then consolidations lead to breakouts. Then you got a trend again. Lower highs, lower lows, lower high, lower low. And then as you reach the extreme of the trend, you get whipped out, and so on and so forth. So that's not, it's not mathematical. Let's look at another one, maybe a better example. So basically markets contract, they expand, they reach extremes, they whip out stops at the extremes, then they contract again, and the process repeats itself. Contraction, breakout, trend, reaching extremes, whipping out stops for the latecomers on to the trend, and then we consolidate again and we break out over and over again. So let's look at one more just to demonstrate this picture. This is a good example. Let's see if we can stretch this. So you have a trend, so we haven't got a consolidation yet. Then it starts to whip out stops, consolidates, then breaks out, another trend, higher highs, higher lows, whip out stops, don't make new highs, consolidate. Let's get rid of these, let's hide this a second. We're going to have to delete that. So we had higher highs, now we have the range here. Pop up, we're in a range again, backing and filling, then breakout again, lower lows, lower highs. So you get the picture. Markets contract, they expand, they contract, they expand. So why am I going through all of this? The reason for this is to say that if we're going to trade a higher win rate and a lower risk to reward strategy, we're going to need to trade the return to the mean, reversion to the mean strategies. So typically you're going to get a higher number of trades, and you're going to, here's the mean, and you're going to buy here and you're going to sell here, and then you're going to sell there and you're going to buy back here, and so on and so forth. So you're making a lower risk to reward, but you're doing it on a higher win rate. So the win rate is high and the risk to reward is low. What's the problem with this system? You need to maintain this win rate, and we all know that it doesn't take a lot to get the direction right but get taken out on a stop. You might enter your short here and get taken out here. You may get in here, the stop may hold, but it may not get to your target, and then it comes back and it takes out your stop. So basing a strategy on a win rate, in my opinion and in my experience over the last 10 plus years, is a way to build up self-esteem in the short term, but then you get killed when the eventual losing streak comes. Your curve is going to look like this: lots of small gains, lots of small wins, and you're going to move up like this, and eventually you're going to catch a streak that gives back most or all of your gains over an extended period of time. So what is the better strategy, in my opinion, is to forego the win rate, lower the win rate, take multiple stops, but then catch those big risk to reward or reward to risk trades. How do you do that? You keep using a system, like let's say here's this chop here. You're going to use a system by which you keep the stop small. You're going to enter here, it doesn't work, you take a little stop. You enter here, it doesn't work, you take a little stop. Eventually you enter somewhere where the stop holds, and you have a system by which you can take advantage, whether it's trailing behind a moving average, channels, lower highs and lower lows, so on and so forth. You have a system by which you can make those big reward to risk trades, but you take several small hits to get to those big gains. Now, if you've studied statistics, and probably this is a good time to bring over this, which I'll also link at the bottom of the video in the description. This is a streak calculator. Now, the series length, you can use this with your own trading if you keep data, and I highly recommend that you do keep data in a spreadsheet, or at least write it down on a piece of paper. Series length means the number of trades. So here I've put in 20. Let's say we take 4 trades a day, and there are 5 trading days in the week, so that's 20. So this is a week's worth of trading. We want to know the streak length, and this is not the winning streak length, but the losing streak length. So, and then this gives, then the loss probability is our loss rate. So I've put 66.66, meaning I'm assuming we win 1 trade out of every 3 trades. So a third of our trades are wins, 2/3 are losses. And then streak probability. And if I press calculate here, it gives us 62.882%. Now what does this mean? This means that we have, on any given week, we have a 62.882% chance of taking 5 losers in a row, trading 20 trades within that week. Now this can help you to recalibrate your brain, because people don't want to go on losing streaks, and this is what makes a high risk to reward, low win rate system difficult to trade, because 1 out of 3 is pretty low. 33% win rate is a pretty low system. There are even lower win rate systems that produce bigger gains, such as the turtles. If you've ever read about the turtle experiment in the 80s, where this guy created this bunch of trained this bunch of traders, like new traders, to make millions on his millions, and they had a super low win rate, like 16%. 1 out of every 8 trades, 1 out of every 6 trades would win, but it would win big because they would stay in the trade. So you can change the number. Let's look at 4. Nobody likes to lose 4 times in a row, yet we have over an 80% chance in any given week of losing 4 trades in a row if we're winning 1 out of every 3 trades and we're taking 20 trades in a week. You can change the numbers. If you look 40 trades in a week, maybe you take 8 a day. To lose 4 in a row, if you take 8 trades a day, you've got a 96.94% chance of taking 4 losers in a row if your win rate is 1 out of every 3. That's pretty close to 100. That means over 19 weeks out of every 20 weeks you can expect to hit 4 in a row. So have a play. I'd advise you to have a play with that. I'll link it below. And all of this to say that what makes a high risk to reward but low win rate system difficult to trade, it's the fact that you have to take so many losses, as we said here, 1, 2, let's just put 3 losses there, and then you catch the eventual win for like 5R. So you lose 3 trades for 1R, minus 1R each, minus R, and for those who don't know, R is a risk unit. And then you catch the 1 win, and that's plus 5R. So you've netted plus 5 minus 3, you've netted 2R over the course of 4 trades. So if R equals $100, let's say, then over the course of 5 trades on this day, you made $200 because 2R equals 2 times 100, $200. Okay, but before that you had to lose 100, 100, 100, and then you hit the $500 there. This is difficult for 2 reasons. Number 1, as I said before, most people don't like to take multiple losses. They doubt the system, and if you skip this for whatever reason, you've completely skewed the system, because you'll probably end up taking a bunch of stops again after that win, because the losses tend to come in clusters as we trade the contraction, and then the wins come as we move out of the contraction. And then, as you know, based on what we just discussed, if you come out of contraction and you trend, you're going to head back into a new contraction. So that means stops again. So in order for this system to work, it's all too easy to skip that 1 big win that's going to keep your system expectancy positive. So the takeaway from this video is to take every trade within your plan, and know that a system that has a low win rate but high risk reward to risk ratio is going to be, the success of that system is going to be dependent on you catching those wins. If for whatever reason you miss that, it's going to it's going to skew the results and lower your confidence. Not only do you have to be present for the win, you also have to hold on to the win. So when this trade goes this much in favor and then a 50% retracement, you can't trail your stop above this high, this little micro high here, or move your stop to break even lest it come out and take you out, or try to trail once you've got X amount of dollars here and then you don't get the full move. You have to have a systematic way of capturing big enough wins to offset those multiple losses. So that's all I wanted to say in this video. It's quite a complex subject, but I hope I've given you a few things to think about. Like this video if you got something out of it. Don't forget to subscribe to keep up with my Top Step Trader journey and catch up with me with whatever I've got to share by way of stats and so on and so forth. And remember to stick to your plan and follow your rules. See you next time.